The long-term trend in the stock market is historically quite positive. So why are so many investors afraid of stocks? Because the long ride to the top can be a roller coaster. And listen, some people love roller coasters. I used to when I was younger. I do not like them now. They hurt my back and they make me nauseous. And that's how a lot of investors feel once they've accumulated a nest egg that represents decades of hard work. They're not looking to get jostled around in the market with wild swings up and down, no matter how exciting the view might be from the top one day. Studying the markets and investors has been my life's work. Investing may be a long term game, but it's not set it and forget it. Our world changes over the decades. Sometimes it changes a little at a time, and sometimes it happens very quickly. Right now is the perfect time to talk about how much the markets and investment products have changed again. I'm identifying it as the fourth major shift in the past 30 years that has required investors to learn more than usual about the world of investing and the investment products available just to keep pace. My name is Carrie Schultz, and I've been a registered financial advisor since 1992. I've managed money for clients in every swing of the market imaginable over those past 30 plus years. I mentioned I feel we're in the fourth major shift of investing, so let's take a quick look at the first three. The first shift started right as I began my career. The early 1990s represented a revolutionary time for investors as we learned about successful withdrawal rates in retirement. Now colloquially known as the 4% rule, these findings even won the Nobel Prize in Economics, helped younger investors better understand how much they needed to actually save for retirement, and it helped retirees know how much they could spend each year and expect their accounts to last a lifetime. These findings are now the bedrock of retirement plans and calculators everywhere, but it was exciting information back then. It changed the industry and it required investors to learn a new strategy for success. The next big shift came with the advent of Yahoo and Google in the late 1990s. The internet and these search engines set the stage for online trading and unparalleled market information and control at investors' fingertips. More self directed investors than ever started trading their own accounts, and it seemed like nobody could miss because everything was going up. But then that frothy bubble burst hard, and the market tanked, leaving many investors seeking professional financial advice about what to do next. Education around asset allocation and risk management were in high demand. The third major shift for investors was the financial crisis of 2008. If you didn't go through these years as an investor or an advisor, I can't stress enough how the ground shifted beneath our feet on a daily basis. The very foundation of our financial system almost came crashing down with one bank failure after another. This set the stage for many changes that can't all be covered here, but a major one for retirees at the time was the zero interest rate policy that lasted 15 years, coupled with sweeping changes in the municipal bond market. Access to your safe money getting a decent yield dried up overnight. Investors had to either get nothing sitting in cash, take on more risk in the stock market, or learn about new investment products that could produce some yield. Learning about new investments again was at a high point. In the years since the financial crisis, three things have been happening at once that I see as the fourth major shift for investors that require more new learning than usual: increased volatility, asset correlation, and the rise of artificial intelligence. Stock volatility is almost twice what it was now in the previous 2 decades, according to the research firm DataTrek. And in their words, markets are just more twitchy than ever, as unexpected events simply hit stocks harder than they used to. With feedback I get from investors regularly, I know we feel it. Access to market news is ever present, and trading is at our fingertips. This information and access gives investors more power than ever, yes, but it also exacerbates panic selling out of fear and panic buying out of fear of missing out. Computer quant models are also increasing the speed and volume of trading that leave investors more vulnerable. And the fact that economic uncertainty is also at a high point that has not retreated since the pandemic in 2020, and it's easy to see some reasons why volatility is up. The second thing that's been markedly higher since the financial crisis is asset correlation. This is a real problem that many investors aren't aware of to what degree this is happening. The reason asset allocation became the bedrock of investing advice is because of Harry Markowitz. I think most investors understand the basic concept of asset allocation. It's not prudent to have all your eggs in one basket because if one basket drops, you don't lose all your eggs. Harry Markowitz won the Nobel Prize in Economics for his modern portfolio and efficient frontier theories of asset allocation. And of course, that is true to a point. Traditional asset allocation is becoming much less effective. The idea that when one part of your portfolio is not doing well, you should expect another area of your investments to be thriving so that the overall ride is smoother and ultimately also produces a better long term performance. The problem is that correlation has been increasing the past 15 years. I know you feel it. How many times have your bonds gone down at the same time your stocks did? The answer, by the way, is about half the time. And guess what? Traditional diversification has been failing us right when we need it most during a bear market. It seems that when markets are falling, everything falls. And for the large part of it, that's actually true. And lastly, artificial intelligence or AI is an economic and investing opportunity the likes we haven't seen since the dot-com years we started to experience back in the late 1990s. And just like back then, the concepts of AI are not always easy to understand, and it's not always clear which products and companies will be the winners in the long term. As investors, many of us feel we want to be in early on this AI era, but where? And anytime you're early to the investing game, the stakes are high, both for rewards and losses. So the higher volatility that exists now in general is exponentially higher in AI investing. And since investors don't want to miss out on the potential AI boom ahead, the lessons of the dot-com bust have put risk management at the forefront once again. Since investing is one cost benefit analysis after another, we have to factor in that extra risk to the relatively same average annualized returns. Because we should expect higher returns by taking on higher risk, but that simply hasn't been true to this point with market averages. This heightened uncertainty and market volatility and asset correlation has led investors to start learning more about protective investing to answer that cost benefit analysis between risk and reward. Protective investing is a portfolio management philosophy that thinks beyond a simple mix of stocks and bonds to minimize risk and maximize return potential. The idea and implementation of protective investing has been around for decades, especially with the use of options like puts and calls. But it's just now, in this past handful of years, that investment products are available that make access to protective investing easy and available to every investor. While these new investments are easy to acquire, they are a bit more complex and require the investor to understand how they work and the difference between the products available. At this point, we can invest in protective investing through UITs, ETFs, annuities, and structured notes. In the next few weeks, I'll be explaining how each of these investments work. With new information, potentially come new decisions. Thank you for listening today and stay tuned in the days ahead to learn more.